This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
What do you say to people scared stiff in cash?
We've got an administration, presumably, that will be pro-business, lower taxes.
With Lisa Mateo on markets.
AI affecting demand for cloud computing.
And Michael Barr with news.
U.S. Secretary of State discussed the conflict in Gaza.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
All right, good Friday morning from the Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Jess Menton. Exactly, Jess Menton, the effervescent Jess Menton, sitting in for Tom Keene for the next couple hours. I'm not sure where Tom is. I'm thinking Paris,
I'm thinking
Rome,
somewhere in Europe as well.
something like
if
that.
I had to
I
guess.
just picture him sitting in a cafe with a carafe of the local grape and him just kind of holding court there. So that's kind of where he is. But we're here. And we're looking out after global Wall Street. We got a lot of good, smart people coming in. Leading it off, Robert Teeter. He is the Chief Investment Strategist at Silvercrest Asset Management. He's in our studio. We're going to kick off with him in just a couple moments to get his thoughts about these markets, 2024, and what to look for 2025. Thomas Martin, Senior Portfolio Manager at Globalt Investments. We'll get his thoughts on these markets here. So we got a lot to do on the market side, a lot to do. What are you looking at, Jess? Because, I mean, you cover the markets for Bloomberg News, and you write a lot. You are very prolific on Bloomberg News side. What are you looking at?
Well, because we're getting toward the end of the year, obviously, and we're about to have the calendar turn, we look at a lot of size and scopes across what's happened so far this year. And you brought up the SPW when you're looking at equal weights. So far this year, if you looked at kind of on an annual basis, the S&P 500 up almost 27% year to date, but the equal weight up about 13%. But unfortunately, it had a really strong quarter in the third quarter, but it kind of gave up those gains on the equal weight and is actually down close to about 1% in the fourth quarter here.
And that's not good, as I remember from my business school teaching. I like to see a broad breadth of participation in the marketplace to signal the health of the market.
And Jim Paulson, who, I mean, he was retired now, but he still puts out newsletters, but he worked at Wells Fargo, Luthold Group, but he's been covering this pretty closely, as well as other strategists on Wall Street this year, but looking at how, in this bull run since October of 2022 when it began, you're still seeing that underperformance in real estate, healthcare, materials, but it'll be interesting to see how this plays out over the next year. If you're looking from an earnings perspective from your buddies at Bloomberg Intelligence, they're seeing that earnings broadening out next year.
All right, very good. All right, just to go to our first guest here, Robert Teeter. He's the Chief Investment Strategist, Silvercrest Asset Management. He joins us here in our Bloomberg Interactive Broker Studio. So he gets a double gold star for coming in on between
bright and early.
Yeah, exactly. Robert, again, Jess was just mentioning the lack of participation maybe in this marketplace. When you look at the S&P up 26%, the S&P equal weighted index up 12, 13, 14%. So a big divergence there. Is that a concern for you?
It is a bit of a concern. I think most of it is tied to moves in interest rates, in my view. We've had a lot of these head fakes where you've had enthusiasm over rates coming down more quickly. That's led to a broadening out of markets. And once again, we've had that rug pulled out from under us with, rate expectations for next year now being dialed back pretty significantly, and with the 10-year heading higher. And as the rate on the 10-year heads higher, people get more and more concerned about smaller companies, and you have that narrowing of the market where the winners keep winning and the laggards keep lagging by quite a bit. The tide could turn for 2025, but that's been the strongest relationship that we've seen for that relationship between large and small has been where rates are and where they're headed.
So how are you advising clients to position going into next year?
We're pretty enthusiastic about small caps for next year.
Really?
One of the key reasons is the
never
M&A
works,
backdrop.
dude.
It has
It's
been a long time not working. Yes, but we do see a couple of new catalysts, and those are really with the change in Washington. So M&A backdrop, that was a very slow environment for most of 2024. Everything we're hearing is that the backlog of deal activity is picking up. People are pretty enthusiastic. That tends to accrue to small caps. They tend to be the acquisition target, and that gets you a premium there, and that helps a bit. We think the broadening out will continue slowly as rates head slowly lower over the course of 2025. I'll probably say slowly 3 or 4 times, but we do think that's headed lower. That alleviates a little pressure as well. And then lastly, we see some of this profit margin expansion that's been mainly in large caps broadening out to the small cap space as well. Of course, there are a lot of non-earners in indices like the Russell 2000, but we do think there's potential for profit margin gain as AI and productivity spreads to a broader segment of the market.
I just pulled up in my G, where I have a lot of my charts saved. It's the Russell 2000 relative to the S&P 500 year to date. So if you look at this year, it's underperforming the S&P 500 by 14 percentage points. So that would be the worst underperformance since actually 1998, and the fourth consecutive year in a row that the Russell 2000's underperformed the S&P 500. So when you look at an index like that versus the S&P 600, better earnings potential in the 600, obviously, than the 2000 because of the zombie companies in the 2000. Which way do you play that?
Yeah, absolutely towards the S&P 600, the earners. Sometimes when you get these quick turns, it accrues to the whole index, and some of the quote unquote garbage rallies faster. But I think for the full 2025, the reason we're enthusiastic about small caps, it is the higher quality, profitable companies in small cap, narrowing the gap against their large cap competitors.
Which ones do you think are more competitive and more profitable in particular industries?
Yeah, I think it's really a stock by stock situation, not only in small cap, but in large cap as well. So our view has been that the driver going forward will be less from the economic side, less from the multiple side, and more from the earnings growth side. And the earnings growth side we see really coming from profit margins rather than the top line. And so it's just this case-by-case implementation of technology-enabled efficiencies, boosting margins, and that can come in any industry or any company at any time. So it's a harder market. We think it is one that lends itself more to stock selection, understanding management teams, understanding how the environment might shift from the creators of AI to the users of AI, and those users of AI really deploying in an effective way to boost margins.
What are we doing in the bond market here? I can sit there in a 2-year treasury and get 4.33%. I don't have to be a hero. Do I take some credit risk here?
We have not been big fans of credit risk. You're absolutely right. You get a pretty good yield without taking on that illiquidity premium or in private and a credit risk premium in the credit space. So we've been pretty cautious there. We've missed out. Obviously, those are areas that have done quite well, but pretty easy to sit at the short end of the curve and get close to 5% and be pretty content there.
So when people want to talk about, especially the annual gains in the S&P 500 being up once again more than 20% this year, second consecutive year in a row, and the first time we've seen that since the late 1990s, how are you thinking next year can shape out, and can that continue to where we'll still have double-digit, maybe even more than 20% again for potentially a third consecutive year in a row?
I see that as a pretty low probability. So our base case is really 9% gains, just tracking earnings higher, holding multiples where they are. Street consensus is more like 15%, 14% earnings. We're at about 9%. You could see a case where enthusiasm builds. We've got pretty high multiples here. Most of the 2024 gain, about 2/3 of it has come from multiple expansion. So we think we've kind of pulled forward some gains. Unlikely to see that happen, but you could always push higher to those 90s type of multiples. I think that's unlikely. And the big key for us is really the economy. If there's no recession, we think that earnings backdrop holds and the gains continue, but only at the high single-digit level, not much more than that.
Why do you think? I mean, the street. I think one of the risks, perhaps in the market in 2025, is the earnings risk, because I think I've got a Fed. It's going to cut maybe a couple times. So that's not really going to be a catalyst for me. Earnings really have to come through for this market to move higher. And again, 13, 14, 15% earnings growth, which seems to be dialed into street consensus, that seems pretty. I'm not going to say aggressive, but boy, that's a heavy lift, I would think.
I think it's a heavy lift as well, especially when you look through at a sector level. Some of the cyclical sectors are expected to see pretty high earnings gains. I'm not sure how that happens unless the economy re-accelerates, and I don't see that happening. I certainly don't see a recession, but if you're tracking along at 2.5% GDP, I'm not sure how you get an acceleration in some of the cyclical space. So that's one reason we're a bit more conservative on the earnings front than street consensus.
We only have about 30 seconds left, but what's the top advice you'd give your clients going into 2025?
Yeah, I think it's stay the course. Paul was mentioning about the long-term compounding effect, and I think really stay the course here. There's no immediate big recession. There's no giant imbalance in markets right now. Economy looks okay. Earnings look okay. Just keep compounding that earnings growth going forward.
That's the message I give to my kids, 3 of whom are in the working force. Max your 401k.
That's right, yeah.
And I think they're doing it, and I think that's going to be
I hope so.
A good thing. Robert Teeter, thank you so much for joining us. Robert Teeter, Chief Investment Strategist, Silvercrest Asset Management, joining us here in studio on Friday, December 27th. I mean, who does
Brownie
that?
points.
Exactly. I mean, definitely. So we appreciate that. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Jess, and Amy. Aviation experts say that a Russian air defense fire was likely responsible for the Azerbaijani plane crash the day before that killed 38 people and left all 29 survivors injured. Azerbaijan is observing a nationwide day of mourning today for the victims of the crash. The flight was en route from Azerbaijan's capital of Baku to the Russian city of Grozny when it was diverted for reasons yet unclear and crashed while making an attempt to land in Kazakhstan. Former Undersecretary of Defense for the Middle East, Mick Mulroy, says if it was the Russians, then he does not expect Moscow to be forthcoming about it.
Whoever fired that missile at this aircraft, whatever military unit it is, already knows they did this. So if this does prove to be them, then not only did they do it, which shows a pretty profound act of negligence, but it shows a willingness to try to cover it up.
Former Undersecretary of Defense for the Middle East, Mick Mulroy, spoke to ABC. Russia initially said they believed that it was a bird strike that led to the crash, but shrapnel punctures can be seen in the tail section of the plane. A month after a stowaway on a Delta Airlines flight from New York to Paris, we're learning another attempt has been foiled in Seattle this week after a passenger got on board a flight to Honolulu without a ticket. Officials say the stowaway got off the plane and was eventually tracked down inside an airport bathroom. The TSA confirms the passenger was screened at a security checkpoint, but was somehow able to bypass the identity verification process and make it onto the plane without a boarding pass. Aviation analyst John Nance.
This has got to stop because there is a very definite security risk in having people get aboard without a ticket.
Aviation analyst John Nance spoke to ABC. According to a new study, pregnant women infected with COVID-19 were found to have a higher risk of severe complications, including emergency C-sections and even death. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Jess, Amy.
Appreciate that, Mr. Barr. Appreciate that with the news there in New York. I'm Jess Menton here with Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. Jess, what's the big theme here? I'm looking at, you've written a lot here about these markets in 2024. What kind of got your attention here as we wrap up the year?
So I wanted to look at an annual basis because not just the S&P 500, but if you're looking at how the U.S. performed relative to the MSCI World Index, and if you exclude actually how U.S. stocks performed, actually, if you're looking at the U.S., it's the best performance annually since about 1997 when you're comparing that to international growth. And I know a lot of times when we were going into the decade of 2020, obviously right before what we would have been with COVID, you would have thought that obviously you would have seen more international participation, but obviously the pandemic changed a lot of those things. But you had another quite strong outperformance of U.S. stocks this year relative to the rest of the world, Paul.
And what we heard a lot about was, and I've heard more about it in the last 3-4 months, about international money coming into the U.S. market.
Right.
And because that's just where the action is. It's where the returns are. And you can look at the European market, you look at the UK market and say, boy, there's value there, primarily because they don't have a lot of tech exposure in that market. But the performance just isn't there.
That's right. And especially if you're just looking how the U.S. has continued to perform over the years here, and especially if you look at even, let's see here, 1, 2, 3, 4, 5 of the last 7 years posting double-digit growth in the S&P 500. I mean, it's hard to beat that.
Yeah, so now the question is kind of, what do we do for 2025? What's the performance? So we'll have to see here. But again, you had 2 years of north of 20% returns in the marketplace for the S&P 500. The question is, can you do it a third year? What's the third year going to hold for us here? Futures here, just a little bit light here on this Friday morning, even lighter than expected trading as we saw from the rest of the week. S&P off 17 points, the Dow off 124, and the NASDAQ off 56 points, all about 0.2-0.3%. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Amy Morris. Futures are lower after yesterday's lackluster session on Wall Street. S&P futures down 0.3%. NASDAQ futures down 0.3%. The Dow also down 0.3%. The 10-year Treasury yield at 4.6%, and the 2-year yield now at 4.33%. Bitcoin's rally starting to slow down now. Investors are assessing the impact of President-elect Donald Trump's support for the cryptocurrency sector. Bitcoin right now just about 1% higher. Bitcoin's price is wavering despite MicroStrategy's plan to expand its Bitcoin purchases, and investors have withdrawn a net $1.5 billion from U.S. spot Bitcoin ETFs in the past 4 days. Shares of MicroStrategy are now 1.4% higher in the pre-market. Netflix's coverage of 2 Christmas Day NFL games attracted more than 24 million viewers each. That set some streaming records for the NFL. Netflix shares, though, down 1.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Amy Morris, and that's a Bloomberg Business Flash. Paul and Jeff.
All right, Amy Morris, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us there. So we think about the U.S. economy, Jess, that whole concept of U.S. exceptionalism, how the U.S. economy really coming out of the pandemic has performed significantly better than most of the rest of the world. You think about Europe, you think about China, and that performance is just, I think, really interesting. I'm not sure most Americans appreciate that. The fact that while we're concerned about inflation, absolutely, maybe we're concerned about other aspects of the economy, relative to everybody else, the U.S. economy is in pretty good shape, and particularly as it relates to our good friends over in Europe and the U.K. So let's talk about that. Dr. Vanya Stravikeva, professor of economics at the London Business School, joins us. Professor, thanks so much for joining us here. Give us a sense here, the day after Boxing Day in the U.K., give us your sense of kind of the European UK economy these days and kind of what's the expectation for 2025?
Thank you so much for having me. So unfortunately, the news in the UK are on the bleak side. We got some negative news in terms of growth, performance, inflation is a bit higher than expected. So unfortunately, on the growth front, there is nothing positive from the UK side. Having said that, both from the perspective of the UK and the Eurozone, there are 2 main questions that are on the minds of policymakers and markets as well, which is 1, impact of tariffs, and 2, people are concerned, are we going to continue to see the decoupling between the US stock markets and Eurozone and UK stock markets that we've seen in 2024? And actually, one thing that we don't talk a lot about on Bloomberg, but also in academia, is the impact exchange rates are going to play in 2025. Exchange rates are going to be key for both tariffs and this decoupling that I mentioned. So if you start with tariffs, right? So there is a lot of debate now what tariffs are going to do. And of course, the emphasis is on, the impact on non-US economies. But people forget that the exchange rates can dampen the harm caused by tariffs. So let's take a very simple example. If you have a floating currency, which is kind of the vast majority of countries in the world now have floating exchange rates, and we have a world with US dollar currency pricing of traded goods. So what that means is that the vast majority of global traded goods are denominated and priced in dollars. So when you have that floating currency and dollar pricing, actually, if the dollar continues appreciating, which is the trend we expect in 2025, it's going to dampen the impact of tariffs on the global economy. So imagine Trump raises tariffs by 10% and the dollar, let's say, appreciates by 10%. On net, if all of your input goods are denominated in local currency, actually you're not going to incur any losses as a essentially non-US company. Now, clearly, companies relied on imported input goods as well. So there will be some pass-through of the tariffs onto profits that are negative, but exchange rates are going to dampen the harm that essentially tariffs are going to have on European and UK profits. Having said that,
I was actually just looking at the Bloomberg Dollar Spot Index in the terminal BBDXY is the ticker symbol on this, Paul, and it's actually appreciated more than 6% this quarter, so on pace for its best quarter since the final quarter of 2016. So I'm actually curious, when you're thinking about what this means for the U.S. and especially dollar strength relative to other currencies, how does this shape out in 2025, and how do you think people are positioning on this?
So I do believe the appreciation is definitely going to continue. So one, of course, the tariff dimension, but also the stronger growth in the US relative to the Eurozone are going to widen further the interest rate differentials. So that will be the main driver of the dollar appreciation going into 2025. But the impact on actually non-US stocks is going to be negative as a result of that. So we said some positive news of the US dollar appreciation due to dampening the impact of tariffs and profits of non-US firms, but bad news on global equity valuations. Why is that the case? So what we have is a very interesting cycle that usually takes place, right? We have this risk on, risk off cycle. And what happens is usually when the US stock market goes up, global stock markets go up, and the dollar depreciates. What we see now is a very different phenomenon, right? We have the US stock market booming, global stock markets not performing as well, and the dollar is appreciating rather than depreciating. What does this mean from the perspective of global investors? Someone just mentioned prior to me that actually there is an inflow of non-US investors into US stock markets, which is very unusual. Usually during risk-on phases, when the US stock market rallies, we see that money flows out of the US globally into other stock markets. Now, this is going to continue actually putting downward pressure on global stock markets because foreign investors, and so let's take US investors, when they're deciding, should I invest in Brazil, should I invest in Europe, they're saying there are two components of my return. One is the appreciation of the local stock market in local currency, but also what the exchange rate is going to do. So even if the local stock market appreciates, if the dollar keeps appreciating, actually any gains you make in local currency as a US investor are going to be offset by the appreciation of the US dollar. So US investors are going to be less likely to want to invest globally, and that's where the money is. The vast majority of equity funds are denominated in US dollars. So actually I'm quite negative on what is going to be the prognosis of global equity stocks.
Professor, how are you kind of factoring in a new administration coming in, the Trump administration talking about tariffs? Does that impact your economic outlook for the UK, for the European Union? How are you kind of factoring that in?
So tariffs are definitely bad news for the UK and the European Union. The more open the economy is, and the UK and the Eurozone are definitely much more open economies in terms of imports plus exports relative to GDP than the US. So this is going to hurt those countries. But as I said, actually the depreciation of the euro and the depreciation of the pound is going to help. Now, keep in mind that there is an economy, which is China, which doesn't have a floating exchange rate. So actually tariffs are going to bite much more in China, I believe, relative to the Eurozone and the UK. But the problem with UK and Eurozone, they have other structural problems, right? So their slow growth is driven by a number of factors, not just by the tariffs itself, even though I know most of the emphasis at the moment is on the tariffs. I think fiscal deficit is going to be a huge issue in 2025. So clearly they're present in the US, but the US, because of the growth and the dynamics we've seen in the US economy, is going to be easier probably to handle the fiscal deficits than the Eurozone and the UK.
Something I was watching pretty closely, just as a stocks reporter, is looking at the performance, if you're looking at the USD versus the Japanese yen, and how closely it tracks S&P 500 futures actually this year when it comes to especially global central bank policy, very different with the Bank of Japan relative to its peers internationally. How do you think that could affect movements in currency markets, particularly how the yen is performing?
So actually, I've done a lot of research on FX over 2 decades. I'm revealing my age. And a recent paper of mine actually looks precisely at the link of currency, equity flows, and stock market performance. So there is a very tight link. And essentially, in the short run, this link is driven by what US investors do relative to foreign investors in terms of demand for currency. So what we're seeing now is indeed consistent. The dollar appreciation is consistent with essentially foreigners pouring money into the US because of the dynamics that we discussed, and US investors being reluctant to invest in global markets. But actually, in my research, I showed that the correlation is like 90%. So I developed net supply indices that track very closely global currencies. So indeed, looking at equity markets is the right place when we study currencies. And the dynamics that I'm concerned about in terms of the performance of global stocks are as a result of what I discussed.
Doctor, thank you so much for joining us. Dr. Vanya Strvikeva, professor of economics, London Business School, joining us here to give us her thoughts on global economics. Again, the relative outperformance of the U.S. economy relative to most parts of the rest of the world, and that does include the Eurozone, as the professor was mentioning to us, and the UK, so keep an eye on that. Futures, slightly lower. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Amy Morris. Futures are lower. S&P down 0.3%. NASDAQ futures down 0.3%. Dow futures also down 0.3%. The 10-year Treasury yield at 4.6% and the 2-year yield at 4.33%. Quantum computing shares have soared more than 150% since Google unveiled its next-gen chip called Willow. That's sparking interest in equities tied to the technology. Quantum shares right now 14% higher in the pre-market. A record year for travel in the U.S., pushing airline stocks to a soaring annual outperformance, and the prospect of sustained earnings power points to a bullish outlook for 2025. The S&P Super Composite Airlines Index has now jumped 60% in 2024. Ukraine will block Russian gas supplies via its territory in several days, effectively halting its transit to Slovakia, Moldova, and to some extent Hungary. That contract expires December 31st. Now shares of Brent crude and WTI both 0.7% higher. Again, S&P futures down 0.3%. NASDAQ futures also down 0.3%. Dow futures down 0.3%. And that's a Bloomberg Business Flash. Paul and Jess.
All right, Amy Mars, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene here today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Again, up 26% year-to-date on the S&P 500, 20% plus gain the prior year. What do you do now? I might just sit in my 2-year Treasury at 4.3% until somebody else can argue against that. Thomas Martin joins us. He's a senior portfolio manager, Globalt Investments. He's been in this investment game since 1984. He's got some experience, but let's be honest, his career peaked when he graduated from Duke University. So it's been all downhill since then. Thomas, thanks so much for joining us. I mean, that's been 2 great years for equity investors, for risk investors in this marketplace. What are you telling your clients about 2025?
Well, thanks for having me on your program, Paul and Jess. And you're totally right. Peaked 20 years ago, so long time. It's interesting. So, people get concerned when you've had 20% plus, even maybe 25% plus years in the S&P, and what can you do next? It's interesting. The range of target prices for 2025 for the S&P is a lot narrower now by standard deviation by one study than it was last year, or even in 2022 when we were coming off of 2 very good years. So the underlying fundamentals in the economy, the expected earnings growth of companies and the expected growth rate of GDP and the potential for positive things that can happen, really are forcing strategists and people to be positive on the next year. So, a 10% rate of return in the S&P 500 is sort of the long-term average over the last 3 decades. And that's sort of the central tendency that I'm seeing in the strategists that I see surveyed. So it's quite possible we could have a up year, but I think the outcome range is a lot wider than suggested by that.
I'm glad you brought that up because Ryan Dietrich over at Carson Investment Research, he had an interesting stat where he was talking about how there have been more years since 1950 that saw stocks gain more than 20% when you're looking at the S&P 500 than have had an actual negative year. So when you're talking about the higher probability of a potential to continue on those strong gains, how are you advising your clients to position next year?
Right. Well, we run 2 strategies, types of strategies. One is a more of a global macro asset allocation strategy, where we do overweights and underweights of stocks, bonds, cash, real estate, and alternatives. And we are overweight equities and focused on the United States as opposed to overseas. So overweight there, remaining diversified among the styles. So we do have an edge towards growth into large cap, but we want to have exposure to the other areas. Our biggest overweight is in mid cap growth. And although we are underweight in fixed income, our duration is now matching the index now that rates are up here in the 4.5%, 4.6% area. Where they go from here is an open question. One of our biggest positions where we don't have a defined, we have a zero market weight or a benchmark weight is in alternatives, but we have a pretty big weight there in gold, about 10% in gold in the miners, as a hedge against inflation and global macro uncertainty.
And Tom, you brought up mid caps. I'm glad you did, because actually Goldman Sachs, whenever the Fed had its first rate cut of this cycle back in September, they had an interesting stat where they were looking at the S&P 400 mid cap index and how it's historically trounced both large and small caps a year after the first rate cut. So when you have questions about the trajectory of these rate cuts going into next year, does that affect how you might position in mid caps depending on if the Fed isn't as aggressive with rate cuts next year?
Well, it definitely is a factor, Jess. What's interesting is that this rate cutting cycle seems to be a bit different from the last rate cutting cycle, in that rates are higher now than they were when the cycle started. And in previous cycles, that wasn't the case. Rates were lower. So to your point, lower rates would tend to favor the mid caps a bit more. But there are other factors that go into what's attractive about those companies, in addition to just financing and rates. And these are the companies that are in the growth sweet spot for the most part. I mean, just generally speaking, they're not in small cap land. They're not as dependent upon maybe one or two factors. They are starting to grow their market shares and addressable markets, and they're attractive to the large cap companies that want to make acquisitions. So we still think there's reason to be overweight those, even in this rate cycle, which is maybe a little bit different than past ones.
Just Tom is based down in Atlanta, but he may be the first Atlanta-based guest on Surveillance whose address is not Peachtree Avenue, Peachtree Drive, Peachtree Boulevard. I mean,
I remember you mentioning this a couple months ago and how confusing it is for you when you're down there.
I don't know what's going on down there. Hey, Tom, talk to us about earnings growth here. It seems like the market's discounting some pretty solid earnings growth for 2025. And, if the Fed's not going to be that aggressive in cutting, this earnings growth really has to come through for investors. Are you concerned about maybe the street's a little bit too aggressive in its earnings growth outlook for 2025?
Well, 15% is a big number, and in any year for earnings growth. And when you look at the targets for the S&P 500, the simplest way to do it is to say, what's the earnings number going to be, and then what's the multiple that you put on that. So, 2024 is not yet over, but when you look at the growth rate from whatever that's going to be to 2025, that 15% earnings growth is the number that is the average expected for now. It's high, but when you look at the targets for the S&P 500, none of them are calling for a 15%. Well, not none of them, but the central tendency is the 10% number. So that means that PE multiples have to come in by a substantial amount. And that makes a lot of sense given today's valuation. But that certainly is a risk going forward, is how much does that PE multiple contract, or does it contract at all? Because it's held in here. But if you get the double whammy of earnings disappointment and a PE contraction, then you could be looking for that unexpected flat or down market in 2025.
I'm looking at the Bloomberg Intelligence dashboard. If you go to BI Go and look at equities, you can see even XMAG 7 to see what the rest of the index earnings growth next year is supposed to look at. More than 10% growth if you're thinking about that broadening out. We've talked so much about this year as well as last year, as you know, Tom. So when you're thinking about these sort of different industries like healthcare, real estate, materials in particular, because the markdowns next year are more commodity-related sectors like energy, materials that have been marked down. And it looks like it's supposed to be more broadening out if you're looking at healthcare and other, maybe some of those unloved sectors the last few years. So are you seeing that earnings potential broadening out even beyond? Because it looks like, as well as what the sell-side estimates and strategists are putting together for next year, that's what they're expecting and potentially betting on here.
Yeah, so in 2024, it was mostly tech and communication services, and the Mag 7 as a representation of that. And they had the Mag 7 had 33% growth in 2024, and it's looking like that's going to decelerate to something more like 21%. But on the other hand, the rest of the 493 only grew 4% earnings last year, and it's looking like 13% according to FactSet for this year. And really, you are seeing it broaden out. There's a lot of sectors and industries that earnings growth is expected to be greater than 10% or really close. And as you mentioned, healthcare, which has been kind of a minefield this year, is expecting to have the second strongest earnings growth in 2025 after information technology. Then industrials and materials, consumer discretionary, and even financials and utilities are in there at 9% earnings growth. So it pays, I think, to be a bit more diversified in your economic sectors, and that's where we are in our large cap portfolios, is having those ranges be a little bit tighter, still making overweight and underweight decisions, but there's a lot of companies in that 493 that grow a lot faster than that average would anticipate. There's still some pretty big growers in there in the 20 and 30 and even 60% range.
All right, Tom, thanks so much for joining us. As always, Tom Martin, Senior Portfolio Manager, Globalt Investments down there in Atlanta, Georgia. With our news in New York City, here's Michael Barr.
Thank you very much, Paul. Jess, Amy, aviation experts say that a Russian air defense fire was likely responsible for the Azerbaijani plane crash that killed 38 people and left all 29 survivors injured. Russian authorities initially blamed a bird strike, but former CIA field operator Daryl Blocker says that does not seem to line up with the evidence.
Bird strike seems to be not feasible, specifically with the size of the holes that were in the fuselage.
Former CIA field operator Daryl Blocker spoke to ABC. A second stowaway for Delta Airlines in recent weeks with a person caught on board a flight to Honolulu without a ticket in Seattle. The TSA confirms that the unticketed passenger was screened at a security checkpoint but was somehow able to bypass the identity verification process before boarding the flight. Aviation analyst John Nance says there is concern when two high-profile incidents occurred just a few weeks apart.
These procedures have to be airtight, 100% perfect. And now, because people have gotten on not only by getting through TSA without the proper credentials, but also getting on the airplane, this has to be a major focus. Twice is too much.
Aviation analyst John Nance told ABC it was just last month a stowaway on a Delta flight crossed the Atlantic from New York to Paris. With less than 4 weeks before President-elect Donald Trump starts his second presidential term, he is talking about several issues, including the Panama Canal. Trump posted a message on social media saying to the wonderful soldiers of China who are lovingly but illegally operating the Panama Canal. Panama's president responded, calling that nonsense. Trump is spending the holiday at his Florida estate this week. Finally, tonight, Mega Millions drawing jackpot now worth over $1 billion. A jackpot that has been steadily growing since September. Many are ready to take their chance tonight like this man.
If I win, I'm buying people out. I'm buying businesses. I'm buying up blocks. I'm buying an island.
Now, I'd make money for it, but that's just me. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg. Paul, Jess, Amy.
All right, Michael Barr, thank you so much. We appreciate it. When was the last time you flew on a commercial flight there, Jess?
Actually, a couple of weeks ago, I was in New Orleans.
Okay,
so.
All right. I'm flying January, flying February.
Aruba?
Yeah, and then skiing out west at Steamboat. Airline stocks, they've had a record year. S&P airline index jumping 60% in 2024, outpacing the S&P 500 index. People are still flying out there.
They are, and especially even with travel, everything going on, you look at those TSA numbers still around records here.
Yeah, I mean, I was driving by Newark Airport about a week ago, right before Christmas, and out the door, I mean, you couldn't even get into the airport. The cars were stacked out there. So no, thank you. But we'll see how this goes. So airline stocks, good place to be in 2024.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Brokers Studio, I'm Amy Morris. Futures are lower, signaling a weaker opening for Wall Street following yesterday's muted session. S&P futures down 21 points. That's about 0.3%. NASDAQ futures down 70 points. That's about 0.3%. Dow futures also down about 0.3%, or 152 points. The 10-year Treasury yield is at 4.6%, and the 2-year yield at 4.33%. MicroStrategy announced plans to expand its Bitcoin buying program, but the market's being cautious ahead of massive expiries of open interest in Bitcoin and Ether derivatives. MicroStrategy right now 1.3% higher in the pre-market. Bitcoin has risen about 130% so far this year, exceeding returns from traditional investments like global stocks and gold. Investors are assessing the impact of President-elect Donald Trump's support for the cryptocurrency sector. Bitcoin's rally is slowing, but it is just about 1% higher at this hour. France's biggest billionaires saw their combined wealth decrease by $70 billion in 2024 because of weak luxury goods demands and political instability. The giants they control, LVMH, L'Oreal, and Kering, are some of the biggest losers on the French stock exchange. The owner of Gucci shedding 41% of its value this year. And that's a Bloomberg Business Flash. Paul and Jess.
Amy Morris, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. I'm Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast. That's where you will find us. I don't know, as long as I can remember, and you probably know this better than me, but it just seems like tech has been leading this market forever. And I can't imagine a market where tech does not lead. I mean, it doesn't lead us higher.
All the different acronyms. We've gone from FANGs to Mag 7s. Now people want to call it Batman if you throw in Broadcom.
Big data. Now it's AI. Now our next guest has been on top of all this. Melissa Otto, head of TMT Research at S&P Global Visible Alpha, joins us here in our studio. Melissa, what is your call on, what are some of your top picks in global tech? Because again, it feels like if this market's going to move higher, another leg higher after 20+ years in performance, technology's got to lead us yet again. Do you think technology can lead this market yet again?
Good morning. Happy holidays. 2025, here we come.
Yep.
I think there are a couple of trends that we're really looking at for 2025. First and foremost, are we going to start to see an upgrade cycle? We were looking for that this year. It didn't really pan out. Apple and Dell look very well positioned to benefit from an upgrade cycle. Based on Visible Alpha consensus, we're seeing that analysts haven't really taken their numbers up for an upgrade cycle, but if we do start to see a catalyst there, that would be an interesting theme. Enterprises coming in and saying, okay, we need to upgrade our employees' laptops, our employees' iPhones, and we saw that in mass in COVID. And so, we haven't really seen that cycle kick in yet. So over the next, say, 6 to 18 months, that could potentially be a window where that kicks into gear and would be positive.
It's interesting looking at Apple specifically because the stock's up about 35% year to date. And if you think back to the first quarter of this year, that was one of its worst underperformances relative to the S&P 500 since the dot-com bubble bursting there. But since it made a bottom in the middle of April, it's just continued to take off and defied a lot of those expectations. Obviously, in early May, it announced that another historic buyback program that it still needs to execute a lot of that on. But when you're thinking about more the fundamentals versus the technicals, where do you think this is pointing in the direction when you have other stocks like NVIDIA and very different type of chip company, but when you're thinking about how to position into that next year?
Indeed, we're in an interesting point with Apple. They were a bit late to the game around the whole AI theme. They came out in June at WWDC and revealed their Apple Intelligence, and the market got very excited about that. It drove some upside in the stock, and then it sort of petered out. And I think we're coming into 2025 potentially with this upgrade cycle in mind, and the idea that AI may start to drive more of an enterprise adoption, and that enterprise adoption could potentially lead us into a broader adoption. And I think that's what the market is. That there's some market consensus around that theme. There's still a lot of debate, though.
AI. How much are you buying into this AI thing? I mean, everybody's telling me, Gene Munster, he put it in the context of it's bigger than the internet potentially. How do you think about it? How does that factor into your your thematic research, AI?
The challenge with AI is that in building AI applications, so we've seen, and to your point, we've seen a lot of innovation in the chip and in the model. Where the challenge is in the application layer. And part of the reason for that is that the application layer requires deep domain expertise. And in order to have the application really resonate with the user and really be useful to us, it requires a high degree of accuracy. And I think that's where it's becoming challenging, is that when you have an agent or you have some sort of generative AI bot or tool, it's not as smooth or as streamlined or as accurate sometimes as the user needs it to be. And so I think that's where you're getting some pushback, particularly in enterprises, where companies are saying, hey, if we're going to have our salespeople, if we're going to have marketing, if we're going to have the business side really leveraging this, it needs to be very high quality. And I think that's where, if you're looking for a hotel, for example, and it's a little bit off, that's one thing. But if you're having it write an email for a customer, that's a different thing. So I think having the domain expertise in the application layer is probably making it a bit slower than the market had initially expected.
So, Paul, what do you think is the best performing stock in the S&P 500 this year? Because there's one stock that comes to mind. So you would think it was. It's actually, it was for most of the year. It's Vistra. Actually, so it's the power producers that are tied to the AI play in utilities. So actually that stock's up, if you look at that VST is actually the ticker symbol on this, up 274%. So when it comes to more of the data center type plays, I'm wondering, what's your view on that when it's beyond even just what you think of the cohort of the Mag 7, if you're thinking about those sort of data center plays that people are investing in? Because NVIDIA actually up 183% year to date.
Right. Yeah. I mean, S&P Global 451 Research has done a lot of work on the energy side of it, and Vistra fits right into that with the potential merger of Energy Harbor. They are likely to really benefit from the AI data center energy consumption. I mean, the reality is that all this computation and the velocity of power that is required for a data center is going to increase.
Real quick, 30 seconds, Microsoft. What's your call there?
Microsoft's interesting. They recast their accounting lines. They now have an AI services line. And what's amazing about that is that we can start to really see how AI is dropping into their P&L. And Microsoft last year did about $4 billion in that line, and then based on Visible Alpha consensus, that's going to $18 billion by fiscal year 26. So some real acceleration there.
Yeah, it's just been extraordinary here. So I guess my takeaway is AI is like a thing, and it's impacting a lot of companies, and we're going to be talking about it more and more and more. But I remember just a couple of quarters ago, every company in the S&P 500 talked about
the
AI
earnings
and
calls.
The conference calls.
Right. And Kroger was one of them, too.
Yeah. I mean, McDonald's. Yeah, I don't know. Melissa Otto, thank you so much for joining us. Melissa Otto, she's head of TMT Research, S&P Global Visible Alpha, joining us here in our Bloomberg Interactive Brokers studio here, talking a little bit about technology, presumably going to be a leader yet again in the marketplace in 2025. S&P futures, we're off 20 points here today. The Dow's off 136, and the Nasdaq's off 70 points. All of that It's about 1/3% decline in the index's 10-year Treasury yields inching higher yet again, 4.6%. We'll have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
I'm sorry, it's a boom economy, and that's what we're adjusting to.
Neither party seems to want to take on deficits at all.
With Lisa Mateo on markets.
Stocks are coming off of another record high.
And Michael Barr with news.
Tensions between the U.S. and China have heated up even more.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
Good Friday morning. Jess Menton in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. Coming up this hour, Jennifer Lee. She's the Senior Economist, Managing Director up there in Toronto at BMO Capital Markets. We'll check in with Jennifer, get her thoughts on this economy. Julie Van Ullen, Chief Revenue Officer, Rakuten, on consumer behavior this holiday season. I don't know. I think the malls were pretty packed every time I drove by.
It looked packed.
I mean, I think it's got to be pretty solid. Matt Stuckey, Chief Portfolio Manager at Equities for Northwestern Mutual. I think that's where my insurance is, so we'll have to see how he's doing over there. Riley Sullivan, Senior Policy Analyst at Boston Federal Reserve, discusses recent research and findings on lotteries. Because there's a huge lottery Michael Barr was just talking about. Like $1 billion. I'm buying a ticket today.
I think I will too.
I think, what the heck? I mean, I'm sure
Why not?
I'm feeling lucky, so we'll see how that goes. All right, let's kick everything off here with Amy Morris down in Washington, D.C.
All right, thanks, Paul. Futures are lower across the board. The S&P futures are down 0.4%. NASDAQ futures down 0.4%. The Dow down 0.3%. The 10-year Treasury yield at 4.6%. The 2-year yield at 4.32%. Tesla extending its losses from yesterday when it fell 1.8%. It is set to release fourth quarter deliveries next week. Wall Street expects Tesla to deliver about 510,000 vehicles. That would be an all-time record for any quarter. Tesla shares right now 0.7% lower in the pre-market. NVIDIA supplier tells the Financial Times that semiconductor companies are going to suffer if big tech's spending on data centers slows. Shares of NVIDIA gained 183% this year. NVIDIA shares right now are about 0.5% lower. Rumble, the live streaming platform, rose 3.3% after jumping 28% yesterday. Stock gained 262% this year. Rumble announced earlier this week that Tether, that's the issuer of a digital token of the same name, agreed to invest $775 million in the company. Rumble shares now up 2.2% in the pre-market. That is your Bloomberg Business Flash. Paul and Jen.
All right, Amy Marsh, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Jennifer Lee joins us. She's a senior economist. She's a managing director at BMO Capital Markets. Jennifer, as we think about 2025, I'm not even sure where to start. I mean, let's just start. We've got a new administration coming in the United States. We've got a new Congress about to be seated in the new year. What do you expect from, again, the new sheriff in town from an economic perspective? I don't know if it's, tax policy, if it's tariffs, if it's, changes in immigration policy. There's a lot of moving parts. How does that impact your outlook for this U.S. economy?
Well, good morning. Happy holidays to you both, and thank you very much for having me on. This is it's that key word, uncertainty. Expect the unexpected. There is so much unknowns as we're heading into the new year with the new Trump administration. He's already talked about what he plans to do, everything that he wants to do on his to-do list. Whether or not he's going to be checking them all off on day one, that will be very interesting to see. But certainly, tariffs is the key measure that he's planning to roll out. He's already talking about the 20% blanket tariff on all $3 trillion worth of goods coming into the U.S. And that will be already significant compared to what he did back in 2017, which was, targeted tariffs on about $300 billion worth of goods. So this is a bigger impact. And of course, 25% tariffs on Canada and Mexico, an extra 10% on China. Maybe this is on top of the 60%, so I'm not sure what the figure is going to be. So there's a lot of uncertainty, I think, heading into this new year. But tariffs are certainly the key factor. Taxes, corporate tax cuts, targeted tax cuts, I think, which would be great for corporate America. And of course, different tax relief measures for those who are earning overtime, Social Security, and of course all those other issues like the biggest deportation effort ever in the U.S. Cleaning out all the extra stuff that doesn't need to be spent. That's where DOGE comes in. So a lot of things on his to-do list, but how that's going to play out remains to be seen. And I think this is why we're expecting a lot of uncertainty as we start the new year.
The latest estimate for the Atlanta Fed's GDP Now model for the current fourth quarter, actually above 3%, Paul. And of course, we were talking about earlier the economic growth projections. If you look at the ECFC function in the terminal, that can pull it up for you on a quarterly as well as an annual basis. So, Jennifer, I'm curious because year after year, especially coming out of COVID, there's so much doom and gloom, even for the expectations in 2023, 2024, that a lot of economists ended up being on the wrong side of that and getting it wrong. So what are people getting wrong about next year? Because I feel like once we wrap up a year and look ahead, we always have these kind of anticipations that never quite come to fruition when you look a year out.
That is true, and we have been, I think, on too low on our growth expectations. We were never in the recession camp, thankfully, but I think everyone was always too low on their growth expectations. We've got about 2.25%, just under 2.5% penciled in for next year. Where I think the miss has been is certainly from the U.S. consumer. The U.S. consumer continues to be the big driving force of the broader U.S. economy. That, and of course, over the past few years was all the business investment and government spending as well, helped with the CHIPS Act and the IRA. That certainly helped boost the economy. But the U.S. consumer continues to surprise, and we should always say never, ever underestimate the U.S. consumer. Just the last November data for personal income and spending showed continuing spending. It wasn't exactly super strong, but they were still spending. And also in those areas that if things were really tough, they wouldn't be spending on, like recreational goods and services, recreational vehicles, that area. There's a bit of a pullback on dining out, hotel stays, but overall still decent consumer spending. Still decent consumer wages. Savings rate just over 4% is still pretty decent as well. So I think that's where the mistake has been. So we'll have to see how things go in the coming year, just given that we are expecting inflation to tick higher.
So the dollar just in this last 3 months is up, nearly 7%. And for the Tom Keenes of the world that like to, vacation over in Rome or Paris or London, it's a good thing. What do you make of this strong dollar, Jennifer?
So the strong dollar has been, at the beginning, it was a function, I think, of the stronger U.S. economy. Like throughout 2024, the mistake has, I think everyone has already underestimated, global growth as well. I don't think there was one G7 country that had back-to-back negative GDP readings. So nobody was in an official recession. Things got revised a lot, which I thought was very interesting. It's just on the data front. But everyone ended up stronger, I think, than expected, especially in the U.S. So a lot of that U.S. dollar strength was reflection of much stronger U.S. strength relative to everyone else. And now, over the last few months, it's been a reflection of, at Fed expectations, at least over the last few weeks in particular, just given how everyone's expecting the Fed to not cut as quickly as originally had been anticipated, just given, again, incoming tariffs, potential impact on inflation. And now with the last dot plot showing only 50 basis points of rate cuts penciled in, which, by the way, I think we sort of have to take with a grain of salt, that certainly put a little new fire underneath the greenback. And that's been very, very difficult to make good calls on the currency market, just given all this volatility. So the Fed not cutting as quickly or as much, everyone else seeming to face slower growth as we're entering the new year and more rate cuts coming, like from the ECB, from the Bank of England, maybe not the Bank of Japan. The RBA is probably going to start cutting rates in February. That is going to also weaken their currencies and put more strength underneath the US dollar.
I'm curious, as the calendar flips to 2025, the Fed, of course, will have new voters. Who are you keeping a close eye on for as we get closer to what people are arguing debatably, that neutral rate? Who do you think is more of a close call on dissents here?
Well, you know what? I think I'm going to go back to see what I think Fed Chair Powell is going to be the key Fed policy maker, of course, that makes the key decisions. And whatever he says sort of reflects, I think, the broader consensus. So I think I'm going to keep listening to what the Fed chair says. I mean, everyone else has their own opinion. Everyone has their own dots. But I think ultimately it's going to be up to the Fed chair to make that deciding factor. So I'm just going to go straight to the boss and say it's going to be Fed Chair Powell.
Jennifer, you're up there in Toronto. How are our good friends in Canada thinking about this new administration, maybe some tariffs? Because last I checked, we do a lot of trading with you guys up there.
Yes, the U.S. is our biggest trading partner. 75% of our exports head down to the U.S. So obviously, we were already pretty nervous because the USMCA is up for renegotiation in May of 2026. So we already knew that there was something going on that front. And now with the new threats of a 25% tariff on both of the U.S.'s trading partners from that deal from both Mexico and Canada, obviously makes us very nervous. And we're going to have to see if we are going to be able to do some, decent negotiations that will hopefully, soften the blow, and hopefully we won't see this play out. Even if it's also going to depend on how long, if he does do what he threatens, which is the 25% tariff on Canadian imports, how long that's going to stick around for. And, hopefully it's not going to come to fruition, but there will be very bad news for our Canadian economy. But we've got about 2% penciled in for Canadian GDP growth this year, or for next year at least. Rate cuts have had a good impact, but all that could be erased if we do see a blanket 25% tariff on all Canadian imports.
All right, we'll stay on top of that for everyone. Jennifer Lee, Senior Economist, Managing Director at BMO Capital Markets. We appreciate getting some of your time with our news in New York City. Here's Michael Barr.
Thank you very much, Paul, Jess, Amy. Azerbaijan Airlines plane craft was damaged by Russian air defense systems near Grozny before it crashed in Kazakhstan during an attempted emergency landing. That is according to Azerbaijan government-backed Caliber News website. National security and defense analyst Mick Mulroy.
It does look consistent with a strike from a missile from the Panzer S, which is a Russian air defense system. It is inconsistent by most experts with a bird strike, and obviously we have seen aerial combat in this region. So if you factor those two together, I think the investigation will likely look to that as the cause, but they need to do a full and impartial investigation to really determine what happened here.
National security and defense analyst Mick Mulroy spoke to ABC. Israel struck multiple targets in Yemen it said were controlled by Iran-backed Houthis, including military infrastructure and power stations. The strikes resulted in at least 6 deaths and 40 injuries, and a UN humanitarian air service crew member was injured. The United Nations Secretary General condemned the Israeli airstrikes. UN Secretary General spokesperson Stephanie Tremblay.
The Secretary General remains deeply concerned about the risk of further escalation in the region and reiterates his call for all parties concerned to cease all military actions and to exercise utmost restraint.
The strikes followed several days of Houthi attacks and launches setting off sirens in Israel. The World Health Organization's Director General said the airport strike happened as he was about to board a flight in the area. The Israeli military later said it was not aware the WHO chief was at the location in Yemen. Finally, authorities in India have declared a 7-day mourning period to honor Manmohan Singh as politicians and the public paid tributes to the country's former prime minister. Flags in India are at half-staff for Singh, who died late last night at age 92. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Jess, Amy.
All right, Michael Barr, thank you so much. Jess, what are you thinking about? What's Wall Street saying about 2025? Are they looking for like a high single-digit type of return after the 2 big years we've had? I mean...
So there's quite a bit of calls for 7,000 if you look at the S&P 500 targets. So if you look at the SPX A&R function, it could take you there, and you could see sort of the expectations of where analysts see those. But usually you typically see more of the equity perma bulls on that side of the coin.
Very good. Yeah, I'm just looking at some of the price targets here. They range anywhere from, looking at 2025, 6,500, 7,000, 7,200. So this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Amy Morris. The Futures Report is sponsored by IBKR. Markets never sleep, and neither does Interactive Brokers. Discover opportunities with CME Group futures across equity indices, interest rates, FX, energy, and more. Access CME futures around the clock at Interactive Broker. Futures are lower after yesterday's lackluster session on Wall Street. S&P futures down 0.4%. NASDAQ futures down 0.4%. The Dow down 0.4%. 10-year Treasury yield at 4.6%. The 2-year yield at 4.32%. Bitcoin's rally slowing down. Investors assessing the impact of President-elect Donald Trump's support for the cryptocurrency sector. Bitcoin is now 0.5% higher. Bitcoin's price is wavering despite MicroStrategy's plan to expand its Bitcoin purchases. And investors have withdrawn a net $1.5 billion from U.S. spot Bitcoin ETFs in 4 days. Shares of MicroStrategy are about 1% higher. Netflix's coverage of 2 Christmas Day NFL games attracted more than 24 million viewers each, setting streaming records for the NFL. The Netflix hit Squid Game had a less than perfect debut for its new season. Netflix shares now more than 0.5% lower. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris, and that is a Bloomberg Business Flash. Paul and Jess.
All right, Amy Morris, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. I am Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. I don't know, holiday shopping done. Feels like I spent about the same. What do you think you did? More or less the same?
I spent a lot on Black Friday and Cyber Monday.
You did.
I'm not going to lie.
You were in
That's where I did all the...
did the damage.
The damage was done.
The damage was done. All right, let's see how this thing's kind of shaping out here as we kind of get a little bit of a look back here. Julie Van Ullen, Chief Revenue Officer, Rakuten, joins us. Julie, here we are here on December 27th. Any early sense of how that holiday shopping kind of panned out in dollar cents?
Yeah, absolutely. First of all, thanks for having me again. This was an interesting holiday, as the whole year has been. It has been pivots after pivots looking at consumer behavior. And what we saw this cyber was the developing behavior of a very uncertain consumer, I will say. We monitored daily shopping pre-Black Friday and throughout main cyber shopping days. And what we saw is shoppers came out very early this year. They were really looking for the deal and not the day. But we had done some research with Harris Poll earlier this year, and we knew that retailers were highly confident that they were going to be able to drive all of their sales during peak moments like Black Friday and Cyber Monday. And I think, unfortunately, many of those retailers who took that tact missed out on a lot of this pull forward of early shopper demand in moments where they feel uncertain and are really willing to pull the trigger when they get enough of an incentive to buy. And we also saw them buying with much more specific intent. I heard you both say that either you shop the same or perhaps a little bit more on those key days. And what we saw was something similar, but much less browsing. So consumers were very clear about what they wanted to buy, and they came to the sites, they purchased in a very purposeful way at a very high average order value per trip, meaning that they were ready, they knew what they wanted, and when they got that incentive that they needed, they bought.
What were consumers buying more or less of?
That's actually one of the most interesting trends of this year that's certainly new to me, having been in this space for a long time, where leading up to Black Friday, we saw a trend that I started calling first me, then you, which was to say that consumers were buying from very non-traditional gift-giving categories. Think things like pet care or personal banking. And as Black Friday hit and we're monitoring trends, we continued to see that behavior happen. And we kept waiting for it to shift to more traditional gift giving. And fundamentally, it just kind of didn't. And it wasn't until after Prime holiday shopping, after Cyber Monday, really, that the last minute shopping started to move back toward normal gift-giving categories like gift cards, toys and games, sports and outdoors. But really fascinating, and I think continues that trend of an uncertain consumer who's using moments that they know that they're going to get the most value to shore up themselves and their families before they started to think about gift giving.
Julie, how promotional were the retailers this season? What did they have to do to get people kind of in the door or clicking that mouse?
They knew that it was going to be a season of value-seeking consumers. It was no secret to anyone. So it was very much a season of stacking and using whatever lever brands could, whether that's their own in-house deals and promotions, whether that's things like free shipping, buy online, pick up in store deals as we got closer to holiday shipping cutoffs, and also, of course, other levers that will drive permission to buy, things like cash back, especially for brands who maybe don't want to do as much discounting. We saw a lot of that happening in the luxury space in particular, but it was really whatever lever a brand or retailer could use in order to be competitive in a market where they knew that consumers were going to be much more loyal to the deal than to the brand, which is exactly what happened.
Now that we're past the Christmas holiday, what other promotions could we see at the end of this year and going into January?
Well, of course, at the end of the year, you're always going to continue to see brands offering deals to offload any gluts of inventory that they may have. We had a lot of interesting shipping moments leading up to Cyber Week this year. So you'll see those deals continue through the end of the year for certain. But what I predict going into 2025 is really that we're going to continue to see this developing habit of a very uncertain consumer and retailers trying to meet them in that space, which means that the deals and incentives can't stop. However, brands and retailers need to figure out what works for them in order to give shoppers the most bang for their buck. And one of the interesting trends we started to see even in Black Friday and Cyber Monday is this very delicate dance between direct-to-consumer brands and retailers, where brands were offering, in many cases, higher cash back than the retailers who carry them, because that's a lever that they have. They have potentially more margin on those products to offer to the value-seeking consumer. And the retailer has other levers, perhaps things like free shipping that they have an ability to offer with better infrastructure to consumers. So it's really going to be this dance to meet the consumer where they are as they continue to focus on things like everyday items and essentials.
Julie, the pandemic, it seemed to bring forward by several years the percentage of market share for e-commerce versus bricks and mortar, and e-commerce really grew. Where's that relationship now, e-commerce versus bricks and mortar for most retailers?
E-commerce did grow, leaps and bounds. We took what we saw about like a 5-year leap into the future in terms of e-commerce growth, and it really does continue, but we are seeing a dramatic increase this year in terms of in-store behavior. Rakuten has ability to give cash back in store as well, so we monitor these trends. And that piece of our business has been one of the most dramatic areas of growth year over year. And I think we're going to continue to see that into next year, especially with that very highly coveted next generation Gen Z shopper continuing to grow and bring strength to the market. They prefer a very tactile shopping experience, worried about quality and sustainability. So I think that we're going to continue to see that trend move more toward brick and mortar next year. But again, that doesn't change the fact that this is still a value-seeking consumer. So in-store retailers are going to need to find those incentives to continue to drive shopping in store.
All right, Julie, thank you so much for joining us. Always appreciate getting a few minutes of your time. Julie Van Ullen, she's the Chief Revenue Officer at Rakuten, giving us kind of the latest on what we're seeing out of the holiday shopping. And again, I think most experts looking for kind of a low single-digit to mid-single-digit growth in retail sales when all is said and done. E-commerce continuing to be a huge part of that. But again, bricks and mortar still part of the experience, and kind of that omni-channel is what we hear from a lot of retailers integrating both e-commerce and the bricks and mortar. S&P futures minus 25, Dow futures minus 178, NASDAQ futures minus 95. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Amy Morris. Futures are lower. S&P futures down 0.4% or 24 points. NASDAQ futures down 0.4% or 88 points. And Dow futures are down 0.4% or 170 points. 10-year Treasury yield now at 4.59% and the 2-year yield at 4.32%. Quantum computing shares have soared more than 157% since Google unveiled its next-gen chip called Willow, which sparked interest in equities tied to the technology. Quantum shares up more than 8% now in the pre-market. A record year for travel in the U.S., pushing airline stocks to a soaring annual outperformance. And the prospect of sustained earnings power points to a bullish outlook for the coming year, 2025. The S&P Super Composite Airlines Index jumped 60% in 2024. Ukraine is set to block Russian gas supplies via its territory in several days, going to effectively halt its transit to Slovakia, Moldova, and to some extent Hungary. That contract will expire December 31st. There's a Brent crude now 0.9% higher, WTI more than 1% higher. And that is a Bloomberg Business Flash. Paul and Jess.
All right, Amy Marsh, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene, and I am Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube as well, so you can head over to youtube.com, search Bloomberg Podcast, and that's where you will find us. S&P Equal Weighted Index, year-to-date up 12.6%. SPX, the straight-up index, I don't know what you call that.
Right.
Market cap weighted.
The broad index.
The broad index up 26%. I don't think that divergence is like a good thing.
Also, that 26% gain for the S&P 500, if you went from where we closed yesterday year to date, that would be the third best this century behind 2019 and 2013.
Very good. Okay, so let's put all that in perspective. If I'm an equity portfolio manager, I don't know, what do I do now for 2029? I just kind of rocked it in 2024. What do I do in 2025? Matt Stuckey, he's one of those folks. He's an equity portfolio manager at Northwestern Mutual in the great city of Milwaukee, Wisconsin. Matt, give us a little bow on 2024 from your perspective, and what are you telling your clients about 2025 expectations?
Look, I think 2024 was a testament to the resilience of the U.S. economy, and I think it was a reflection that we also saw in 2023. If you looked at the entry points into both of those years, consensus economic growth expectations were surpassed fairly easily, just in terms of what was expected versus what was actually delivered. And as we turn the page into 2025, the U.S. economy does have some momentum here. The consumer continues to be fairly healthy in aggregate. If you start to kind of do some cross-section, there are pockets of weakness that we can talk about, but certainly the resilience, I think, is the theme of 2024. And that kind of momentum has been lifting into the fourth quarter and into 2025 with some rising levels of confidence for both the consumer as well as business leaders.
And Paul and I were actually just talking about, if you're looking at the A&R function for the S&P 500, where you can look at the average targets. If you look at next year for the year-end targets for 2025, it's actually averaging around 6,500 for the sell side. That would only be about a roughly 8% gain for next year. And I mean, we've written so much about how, especially when it comes to the sell side targets, how often they can get those things wrong and be far behind, especially the last couple of years. So when you're looking at some of these strategists that have certain targets that are trying to play catch up, at what point do you like to use them as potential contrarian type indicators here?
Well, I think sentiment is a level or something that we can look at to kind of see kind of where position sits today. And that does have a powerful impact on how things can play out into the future. And where we see sentiment today is certainly higher than where we started 2024. A couple of things to really look at is just the percentage of consumers that expect the stock market to be higher a year from now. We're sitting at 40-year highs on that number. And on the institutional side, if you looked at the most recent Bank of America fund manager survey, the percentage of investors that are overweight stocks relative to cash is also kind of punching through the highs that we've observed the last 20 years or so. And you add all that up, what that translates to is some of the highest levels of equity fund flows across the ETF and fund complex that we've seen over the last couple of months. So it's certainly an elevated sentiment environment. And it is, like you indicated, pushing sell side targets higher for 2025, albeit in a pretty kind of close range, around 8% higher versus where we sit today.
So, Matt, as people look for value in 2025 for an S&P that's rallied, north of 20% for each of the past 2 years, some folks are saying small to mid cap stocks. Are you in that camp?
We are. And the reason being is that, we kind of see the setup today as somewhat bifurcated in terms of kind of where the economy sits and what the outcomes look like as we kind of look forward to 2025 and beyond. On one hand, if the Fed is able to continue to deliver rate cuts, and there has been a lot of kind of market consternation whether that can continue in 2025, some of the areas of the stock market that are the most sensitive to changes in interest rates are the smaller and the medium-sized companies. Furthermore, if let's say that this momentum that's been building in the economy and demonstrated such resilience the last couple of years were to stall out, we think that translates into an even faster pace of rate cuts for 2025. That to us is something that is attractive if you're just looking at the interest rate side of the equation as it relates to the equity markets for small and mid-sized companies. Furthermore, I think the fundamental bar is a little bit lower if you look to kind of what's priced in here. Last couple of years, 2022. Relative to 2023, we saw flat earnings growth in the S&P 500. It looks like it's going to be up roughly 9% in 2024 and punching through 12% in 2025. But we're paying a pretty high multiple against those expectations for the S&P 500 at 22x. But if you contrast that to small cap companies as an example, the earnings based on a forward-looking basis is down roughly 20%. And so a recapture of some of that earnings power we think is an easier kind of path forward versus punching new highs in terms of earnings growth. And relative to those discounted earnings, we're not paying 22x, we're paying 15 times if we're looking at small cap. So we like the kind of fundamental side as well as the interest rate side of things if we look forward to 2025 as it relates to U.S. small and mid caps.
So, Paul, I was looking at the price to projected earnings multiple of more than 150 times for Palantir. So that's the second most expensive stock in the S&P 500 behind Ventas. That's a real estate investment trust that's looking at the terminal data. So, Matt, I'm kind of curious here because I know that y'all are slightly underweight equities, but more specifically when you're looking at the view of what's expensive relative to elevated expectations. Kind of unpack that for us as far as what sectors you're shying away from and which ones you're adding exposure to.
Well, I think you underlined just a great example of kind of what we're talking about with as it relates to Palantir. We're trading north of 64 times expected revenues, not earnings, revenues for Palantir. I'm not an expert on Palantir; it's not in our portfolio. But if we kind of think through kind of what has to go right for that stock to work over the long term, there's a lot of positivity priced into the stock is all I'd say as it relates to that name. Contrast that to small and mid caps. To me, I think you're looking at a very different setup as it relates to expectations, where like we talked about the price you're paying relative to discounted earnings is attractive on a relative basis versus U.S. large caps. And I think that's probably the place, if we have an intermediate to longer term time horizon, we have some attractive places to allocate capital.
Matt, love to get your thoughts just kind of here. When you guys woke up the day after Election Day at Northwestern Mutual, did you guys change your investment outlook at all to reflect, a new administration, a new Congress? Did that change your outlook?
No, it didn't. I think heading into the election, we thought base case divided government was something that we would see happen, with the GOP taking, the House, Senate, as well as the presidency. I don't think that really kind of changes the calculus all that much as it relates to kind of our positioning. I think if anything, it probably, builds up a little bit of inflation expectations, but also expected growth as you kind of think through some of the regulatory apparatus in terms of the efficiency that the administration wants to tackle there. As an insurance company too, it's a positive in terms of what the interest rate kind of dynamics have been post-election. Despite the Fed cutting 100 basis points, the 10-year interest rate is up 100 basis points, and so if you're an insurance company, that's a good thing.
I was just looking at how the Mag 7 since Election Day, Paul, it's actually up, that cohort that we have in the terminal, it's up around 20% in that span. But then if you're looking more at how the equal weight, it's actually down about 0.4% since Election Day. So I'm kind of curious too, when you're thinking about more of that rotation that everyone likes to keep talking about, Matt, when it comes to the broadening out into next year, because what kind of unloved corners of the market do you like? Because for instance, we're seeing markdowns for earnings projections for energy materials for the next year, but we're seeing some indications that some of the margin pain for safe healthcare is past some of the worst of it.
Yeah, I think you can take that dynamic and also apply it to small and mid-sized companies as it relates to kind of that kind of narrowing that we've seen in breadth, within recent weeks as it relates to markets. Just if you contrast the S&P cap weighted versus the S&P equal weighted, which you touched on earlier, that dynamic is showing through pretty dramatically. Up until recently, we had essentially kind of negative returns day by day for almost 11 days in a row for the Dow, which you can use as a proxy for the S&P equal weight, but yet positive market outcomes for the S&P cap weighted, especially specifically the Mag 7. Yep. Within the Mag 7, that's really been driven by Tesla as well as Google. But, it just shows kind of the narrowness of markets. And we don't necessarily think that translates into kind of a good message as it relates to the sustainability of what we've seen post-election.
Matt, thanks so much for joining us. Always appreciate getting some of your time. Matt Stuckey, Chief Portfolio Manager at Northwestern Mutual, with our news in New York City.
Thank you very much, Paul, Jess, and Amy. Aviation experts say that a Russian air defense fire was likely responsible for the Azerbaijani plane crash that killed 38 people and left all 29 survivors injured. Azerbaijan is observing a nationwide day of mourning today for the victims of the crash. The flight was en route from Azerbaijan's capital of Baku to the Russian city of Grozny when it was diverted for reasons yet unclear and crashed while making an attempt to land in Kazakhstan. Former Undersecretary of Defense for the Middle East, Mick Mulroy, says if it was the Russians, then he does not expect Moscow to be forthcoming about it.
Whoever fired that missile at this aircraft whatever military unit it is, already knows they did this. So if this does prove to be them, then not only did they do it, which shows a pretty profound act of negligence, but it shows a willingness to try to cover it up.
Former Undersecretary of Defense for the Middle East, Mick Mulroy, spoke to ABC. Several tornadoes touched down in southeast Texas, including a couple that were inside the Houston city limits. Stronger twisters were reported in more rural areas. This resident in Plumbrook took cover only to eventually find the house was severely damaged.
We were literally just on the floor just trying to take cover just in case anything was going to come in through the windows. But it all felt like 3 to 5 minutes. And then to find out all this happened in 3 to 5 minutes was kind of crazy.
Finally, according to a new study, pregnant women infected with COVID were found to have a higher risk of severe complications, including emergency C-sections and even death. Global news 24 hours a day and whenever you want it with the Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Jess, Amy.
Michael Barr, thank you so much. We appreciate it. Jess, I'm just looking at the shares of Tesla. Just below an all-time high, but up 83% year to date. So there was a period of time maybe 12, 18 months ago when there was profound concern about just what's the ultimate demand for, electric vehicles. But the market seems to have gotten past that. I think that Elon Musk has done a good job in saying, hey, let's focus in on the robo-taxi, artificial intelligence, maybe things other than actually bending metal and making automobiles and deliveries and stuff like that.
That's right, because if we think back to a couple years ago, in 2022, that stock was down 65%, was up 100% last year, and then obviously, to your point, on pace for another annual gain for the second consecutive year.
Right, so if you take that over to Rich Go, R-I-C-H, Bloomberg's calculation of the wealthiest folks in the world, Elon Musk is number one with a net worth of $468 billion, up $239 billion just in 2024. How about that? This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Amy Morris. Futures are lower, signaling a weaker opening for Wall Street after yesterday's muted session. S&P futures down 0.4% or 26 points. NASDAQ futures down 0.4% or 101 points. And Dow futures are down 0.4% or 175 points. 10-year Treasury yield at 4.59%. 2-year yield at 4.32%. 10-year yield is hovering near a 7-month high, and a gauge of the dollar remains steady on track for its best year since 2015. MicroStrategy announced plans to expand its Bitcoin buying program. The market is being cautious ahead of a massive expiries of open interest in Bitcoin and Ether derivatives. MicroStrategy is 0.7% higher. Bitcoin has risen about 130% so far this year, exceeding returns from traditional investments like global stocks and gold. Investors are assessing the impact of President-elect Donald Trump's support for the cryptocurrency sector. While Bitcoin's rally is slowing, it is still about 0.6% higher. France's biggest billionaires saw their combined wealth decrease by $70 billion in 2024 because of weak luxury goods demands and political instability. The giants they control, LVMH, L'Oreal, and Kering, are some of the biggest losers of the French stock exchange. The owner of Gucci actually shedding 41% of its value. That is a Bloomberg Business Flash. Paul and Jeff.
All right, Amy Marsh, thank you so much. We appreciate that. Jess Menton sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. And we're also streaming live on YouTube. So you can head over to youtube.com, search Bloomberg Podcast, and that's where you will find this. Michael Barr's been reporting on the lottery, right? It's like $1,000,000,001.
I know. Why did I not buy a ticket?
Well, you can buy a ticket today.
That's probably what I'm going to do.
I think I'm going to go out and buy a ticket. And it kind of gets me thinking about the economics of lotteries here. Riley Sullivan joins us. He's a senior policy analyst at the Boston Federal Reserve. Riley, thanks so much for joining us here. Can you talk to us about kind of how the economics of these state lotteries work? Because I know in New England, I think New Hampshire might have been the first modern state with a lottery in 1964.
Yes, exactly. Hey, thanks for having me, Paul and Jess. I just want to say that views expressed are my own and do not necessarily represent the views of the Boston Fed or the Federal Reserve System. But yeah, New Hampshire was the first modern state lottery in 1964. They were in a bit of a budget crunch back then. They do not have a state income tax or sales tax. So they are completely reliant on property taxes for the most part to fund their education system. So they launched the lottery to help bring in additional revenue. And the other New England states quickly followed suit. Massachusetts was the first state to have those scratch-off tickets we now have today, the instant win games. So there's really a long history of the lottery in the New England states.
Unpack for us when it comes to lottery revenues and what that means to fund municipal aid, public education, and other public services.
Absolutely. So each state gets to designate where their lottery funds go to. In, like I said, New Hampshire, it goes entirely to the State Education Trust Fund. Vermont does a pretty similar thing. Massachusetts has it go towards municipal aid, so gives it directly to the municipalities to partially fund education or do infrastructure projects. And the remaining New England states have it go towards just a general fund, which it seems to be those seem to be three pretty common things across the country: general fund, education, or just municipal aid.
Hey, with all these sports betting apps, Riley, are state lotteries, are they seeing reduced funding? Like, I don't know, maybe I can spend some of my speculative money other places other than lotteries?
Potentially, that is a kind of a long-term concern because they do not have the exact same designated funding sources. So some of those go directly towards the general fund versus these designated education funding. But as of right now, lottery is still growing. In the New England states, it's not growing quite as quickly as it is nationally. It still is higher spending. You know, in Massachusetts, it's the highest per capita spending in the country, but it's not growing quite as quickly as it used to. And the designated funding source, its spending on education is outpacing the amount of lottery growth that's happening.
And you mentioned Massachusetts as being the highest per capita spending among residents who are playing the lottery. But what about when it comes to Rhode Island and sort of the highest per capita loss from lottery purchases? Why is that a factor there?
You're right. So back in 2022, which is the most recent data available right now from the census, we see that in terms of payout of prizes versus spending, Rhode Island residents are losing over $300 of personal income annually through the lottery. So it's not really a loss given that it's going towards the state general fund. It's providing services, but it is out of people's pockets to the state. It's about $300. That's because Rhode Island retains a larger share of their state lottery funds to fund the government. They retain over 60% of the prize money spent. They do retain versus payouts, which is the highest in the country.
So what are some of the ethical issues of lotteries? Because I used to work in kind of like a deli, sold a lot of lottery tickets, and the people that were there buying lottery tickets, it was probably not a good use of their money. There's probably some other things they should have been buying. I mean, it could be like a regressive tax almost. How do the states think about that?
Yeah, no, you nailed it. So I think proponents of the lottery like to think of it as it is all in good fun. Like you guys were mentioning, right now it's up to over $1 billion, Mega Millions. At that point, a lot of people play the lottery. You know, people who are very casual gamers like to daydream a bit about maybe how they might spend the money if they happen to win. But there is a concern about the very frequent buyers who maybe have more limited incomes. So it is higher spending is concentrated in lower income communities. So it's not just that they're spending a greater share of their personal income on lottery tickets, they're just spending more, period. So a lot of these states do have programs that try to address problem gambling. Some portion of the funds do go towards gambling addiction services, but the goal is to kind of keep it in good fun and have it be a game versus an addiction.
Talk to us more about the risks of oversaturation, where you do have the introduction of apps like Jackpocket that are enabling the purchase of lottery tickets through smartphones.
Yeah, so, there are applications like you mentioned, Jackpocket, and then also states are starting to roll out online lotteries. Massachusetts is looking to launch an online lottery in the near future, and that will just make access to buying tickets even easier, which kind of could just exacerbate these problem gambling things. So we just need to keep an eye on who is spending the money, where these purchases are coming from, and hoping that we're not taking money away from the areas that maybe need it the most and transferring it to other areas.
Riley, thanks so much for joining us. Riley Sullivan, Senior Policy Analyst for the Boston Federal Reserve, talking about the economics of some of these state lotteries. Back in the day, high school and college, few years, I'd have a few jobs. One was being a bank teller in a bank in Trenton, New Jersey. And then when I was done with that, I'd walk down the street to Eddie's Donuts. And one of the things we did at Eddie's Donuts was sell lottery tickets. And the people would come in and cash their checks. I'd see them later on in the day when I was down in Eddie's buying lottery tickets. I'm like, dude, just put it in, even then at like 18, 19 years old, I'm like, just put it in an index fund. Dude. It's gonna be
before your days on Wall Street. I love it. Is Eddie's Donuts still around?
And so my story from this bank was we were robbed one time.
Oh my gosh.
And on the way out, the guy pulls the trigger and just shoots up into the roof. So then it becomes like armed robbery. So anyway, this knucklehead, across the street was Trenton High School, which had like the 82nd Airborne guarding that school at all times. So many police presence. But not only that, if you turned the other way, it was Eddie's Donuts. Who was in Eddie's Donuts? Half of the Trenton Police Department at any given time.
Oh my goodness. So that was not the place to try this. Okay.
Guy runs out of the bank, turns right, boom, runs into like a whole army of Trenton Police Department.
Wow.
It was
That's an amazing story. I wasn't ready for that.
Yeah, it happens. But anyway, so that's that was my first exposure to kind of like lottery tickets and who buys them.
Wow, I feel like the formative years there really shaped your view.
We could go way back, way back there. Sorry. All right, looking at these markets here, we're going to try to get them open in about 35 minutes time here. The S&P futures minus 25, Dow minus 172, NASDAQ minus 99. That's about 0.4 of 1%. Yields a little bit higher here, 4.59% all year, 10-year. Jess Menton, thanks for sitting in for Tom Keene. We appreciate it.
Always a pleasure.
All right, we'll
see you on Monday.
All right. This is Bloomberg.
But she was the young American standing right through the picture windows.